Hi, how's it going, everyone? This is my Google forecast model. It's a multiple regression model, much like all of your guys' models. I collected data from 2005 through 2011, omitting 2004 when they went public initially, because that data is an outlier. And I talked to Liz, and we decided to leave that out of the model. So I tried to organize this data into an input-output fashion. I highlighted inputs with yellow and outputs with blue on their respective tabs, input and output tabs. So interest is considered negligible for Google. You can see here, for 2005, the interest is 0, 2006, 0, 7, 0, etc. That continues. So this last year, they had a little bit of debt, but it's really negligible because all these values are in the millions. So looking at the input tab, you can see input highlighted in yellow. I adjusted for inflation using the CPI values. We're looking at 11 years, and they do have a current debt. This debt's accumulated as mentioned last year and this year. They're looking into new ventures. They're producing their Nexus tablets and phones, and they're branching out in their different deliverables and points of business. So their data is collected in 3 different lines of business. They have websites. That would be all of their advertising is under websites. They advertise through point and clicks. So different companies, say a airplane company wants to sell tickets to France, and they have it set up to where Google keeps track of you as a user. They see that you're looking at flights to Europe, so now they advertise their flight to France on the side of the website you're viewing at the moment. So it's very user specific, and Google is able to make a lot of capital through that. That's their main source of capital. Second largest source of capital is member sites. This would include Gmail, Google, Maps, etc., etc., etc. That's a huge line of business for them as well. And then they have some random kind of ventures that they're trying. They have a self-driving car. They're considering space exploration. Very out there. A small portion of their revenue, but still significant enough to include. All these, like I mentioned, all these figures are in millions. And then I also collected the beta values for different competitors. We looked at 7 different competitors, and Microsoft is in there, Cisco's in there, Yahoo's in there. And using those betas, we collected an average beta of assets, which was used to calculate the A of I, which was then going to the output tab, used to calculate the stock value. So initially, the stock value was calculated at about $800, which was way overvalued at what the current market price was. So I'll talk about that a little bit later. But I did what everyone else did. We collected all the data. We went through and did a regression model. The difference with my data is that Google's data is extremely linear. I mean, you see this dip right here in the recession area, and I did use a point of data to try to get rid of that dip, but it wasn't worth keeping in the model because, I mean, the R squared without it is already 0.969. And that is also likewise as high of an R squared for the different lines of business, member site revenues and other revenues. So then just to double check, because this is just in Excel, I went over to Minitab and plugged in all the values, and I was looking at the p-values, and we've got very small p-values, so we're looking at very linear model here. So to keep it simple, I just used Google's data, so assuming a linear growth, that Google will continue to grow as they have in the past 11 years, we can look at their data as a source of creating a model. So using that cloud calculated A of I, or I of A, excuse me, of 6.8%, and salvage value, found the net present, found the equity, divided that by total number of shares, which is 327 million. We have outputs highlighted in blue. And I decided that because the initial calculation created a forecasted stock price of $800, that they must be pulling money out to invest further. So directly, right from the revenue, they're saying, bam, we're taking 28% and throwing that back into our business. So the stock price never sees that. And that growth, which we talked about, I think in the first couple weeks of class, that growth is accounted for in my model. This is different than the first model I submitted because taking that growth into account we found a stock value price of $645, which is extremely close to their current